You probably heard Canada cut the first tax bracket from 15% to 14%, and you assume that means one clean rate cut. It isn't. For 2025, that first bracket is quietly taxed at a blended 14.5%, and at the same time, the value of your tax credits gets reduced. So your tax cut is actually two offsetting changes happening at once, and I'll show you exactly where the second one hides. Here's the simple version everyone repeats. The lowest federal rate dropped from 15% to 14%, per Budget 2025 and Bill C-4. I read the fine print so you don't have to, and the fine print is that this change started mid-year on July 1st, which instantly complicates the tidy story you were told. Because the cut only started on July 1st, the first half of 2025 was still taxed at 15%, and the second half at 14%. The Canada Revenue Agency and your tax software smoothed that into a single blended 14.5% for the 2025 year, per Finance Canada. So the first time you see the change, you're not even seeing the real 14% yet. Then in 2026, the same first bracket income drops again, to a full year 14%, on income up to $58,423 after indexation, per Finance Canada. That's the second effective change, relative to what you saw in your 2025 return. So for the first bracket, this really does land as two separate shifts, one year after the other. The government's headline figure is nearly $5.5 billion in relief for 2026, with maximum savings of $420 per person or $840 per couple, per Finance Canada's impact report. That $420 cap matters because it's a lot smaller than the number most people calculate in their head. And here's why the real amount is even lower than that ceiling. Now the part almost nobody mentions. Your non-refundable credits, the basic personal amount, tuition, medical, charitable donations, all work by multiplying a credit base by that lowest federal rate, per Finance Canada. So when the rate falls, those credits automatically get repriced downward too. The same rate cut that helps your income quietly shrinks your credits. Here's the offset in raw numbers. Finance Canada says the lower rate cuts income tax by $10.6 billion, but the value of your credits drops by $5.4 billion at the same time, leaving net relief of about $5.2 to $5.5 billion. That $5.4 billion is roughly half the headline gain, quietly clawed back. If this is useful, subscribe. The next breakdown is already coming. Before I get to the last part, which is the most counterintuitive piece of this, look at how the Parliamentary Budget Officer frames it. The rate cut on its own would cost $9.5 billion in 2025-26, but roughly $4.2 billion of that flows back to government from the devalued credits. The cut is a tug of war, not a one-way gift. Now the counterintuitive finale. Most people assume a first bracket cut mostly helps the lowest income Canadians, but the PBO estimates lowest bracket filers average just $90 in 2026-27, while everyone else averages $330. That's almost 3.5 times more. The middle and upper middle incomes actually capture more of this relief because they have more income riding above the cut's own credit devaluation. If you multiply 1% by your bracket, you'll overshoot badly. On $57,000, Yahoo Finance estimates federal tax falls from about $8,150 to $7,180, around $500 to $70 before credits, yet Finance Canada's real headline is only up to $420. The gap is the credit devaluation eating into your gross savings. That's why the naive 1% math almost always disappoints. Take Sarah, a 32-year-old Ontario teacher on $65,000. Her rate savings land near $350 to $420, but her $23,000 credit base, repriced from 15% to 14%, quietly costs her about $230. That leaves a net benefit closer to $120 a year, a fraction of the $585 she'd get from naive 1% math. The cut is real, just far smaller than it sounds. Here's what to actually do. Log into CRA My Account, pull your 2025 and 2026 notices of assessment, and compare federal tax payable against your total non-refundable credits side by side. If your net saving lands near the up to $420 figure, you're on track. If it's near zero, your credits are eroding the cut. Then use the 14% threshold of $58,323 to plan your RRSP contributions. So the middle class tax cut is really two linked changes, a blended rate and a quiet credit devaluation, and your net saving is often a fraction of what the headline implies. Next, I'm breaking down exactly how Canada's basic personal amount phase-out works and who quietly loses it, If you want to catch that, subscribe so you don't miss it.